Chapter 11, Statement of Cash Flows. In LO 11.3, we start discussing how to prepare the statement of cash flows with the operating activities section using the indirect method. The first step in preparing the statement of cash flows is to calculate net cash flows from operating activities using information from the income statement and changes in current assets and current liabilities on the balance sheet. Under the direct-indirect method, we calculate net cash flows from operating activities by starting with net income from the income statement. From net income, we need to remove any accrual amounts so that only the cash portion remains. The first adjustments that we make are for non-cash items. These items include revenues and expenses that never affect cash, for example, depreciation expense. Next, we remove non-operating items. These items include gains and losses from the sale of long-term assets that do not affect operating cash flows. Common examples are gains and losses on the sale of land, buildings, and equipment. Lastly, we look at the changes in current assets and current liabilities. These changes represent the non-cash portion of some revenues and expenses. They occur when the cash flow for the year does not equal the related amount reported on the income statement. For example, all sales to customers are reported as revenues on the income statement, but only cash collected from customers represents an operating cash flow inflow. The amount of revenue not collected in cash equals the increase in accounts receivable, and we'll take a look at that in a moment in detail. The summary of adjustments to net income is a great chart. I recommend you print this slide out, bookmark it, refer to it in the book. It's excellent. For the statement of cash flows operating activities section, we start with net income and we make adjustments to reconcile net income to net cash flows. We need to add back depreciation expense and amortization expense. We originally deducted this non-cash expense in the determination of net income, so we need to add it back in the same amount to calculate operating cash flows. Next, we need to adjust for the non-operating items. We need to add a loss on the sale of assets back and subtract the gain. Losses are not an operating cash inflow or outflow. The actual sale of the land is an investing activity that we'll discuss later. We need to remove the loss by adding back the same amount to net income. Next, we look at the changes in current assets and current liabilities. We'll go into depth with this in a moment, but if you just need to memorize an increase in current assets is a subtraction and a decrease in current assets is an addition. The opposite is true for a current liability. An increase in a current liability is an addition, and a decrease in a current liability is a subtraction. And we'll look at those and why that is in a moment. Once you've made all these adjustments, you have your net cash flows from operating activities. So, looking at eGames, remember eGames reported a net income of $42,000 and depreciation expense of $9,000 on its income statement. Because we deducted the $9,000 non-cash expense, we need to add that back. So we start with our net income of $42,000 and add back our depreciation expense of $9,000. Next, adjustment for non-operating items. In the additional information we were provided, it told us eGames sold land originally costing $10,000 for only $6,000, resulting in a $4,000 loss on sale of the land. The loss, like I said, is not an operating cash outflow. The actual sale of the land is an investing activity that we'll discuss later. To remove the loss, we need to add back that amount to net income. That $4,000 is not an actual cash exchange. That is just a loss from where we actually received $6,000 in cash for something that cost us $10,000. Now, effects of changes in current assets on cash from operating activities. An increase in a current asset represents a decrease in cash, and a decrease in a current asset represents an increase in cash. So, example, accounts receivable. eGames reports sales revenue of $1,012,000 on its income statement. That does not mean, however, that eGames collected $1,012,000 cash from its customers during the reporting period. We know this because eGames' accounts receivable increased by $7,000 during the year. It was $20,000 in 2020 and went up to $27,000 in 2021. This tells us the company must have collected less cash than its $1,012,000 in sales revenue. Why? Because customers owe the company $7,000 more than before. That $7,000 increase in accounts receivable represents $7,000 of sales revenue that they reported as part of net income that did not result in operating cash flows. For current liabilities, an increase in a current liability represents an increase in cash. A decrease in a current liability represents a decrease in cash. For example, accounts payable. eGames accounts payable decreased $5,000 during the year. The decrease in accounts payable indicated the company paid $5,000 in cash to reduce its liability, for which there is no corresponding expense on the income statement. In other words, the cash outflow to reduce accounts payable caused cash to decrease by $5,000, but net income was unaffected. So we need to decrease net income by the $5,000 cash outflow. So going back to the account receivable, we already talked about this. eGames accounts receivable increased from $7,000 during the year, from 20 to 27. So we need to subtract the increase in accounts receivable of $7,000. eGames inventory balance decreased by $10,000 during the year. This tells us the company sold $10,000 of inventory that was not replaced. This $10,000 is reported as cost of goods sold, an expense, in the income statement, thus reducing net income, but it had no effect on cash. So we need to adjust net income for the decrease of $10,000 by adding back our $10,000. Prepaid rent increased $2,000. Prepaid rent is a current asset. Current asset increase, so we need to subtract it. Increased $2,000. That means the company paid $2,000 cash for prepaid rent in which there's no corresponding expense on the income statement. In other words, the cash outflow to increase prepaid rent caused cash to decrease by $2,000, but net income was unaffected. To adjust for this, we need to subtract the increase in prepaid rent from net income. Now, moving on to current liabilities. eGames accounts payable decreased $5,000 during the year. Current liability, decrease, subtract. Remember, the company paid $5,000 cash to reduce a liability for which there is no corresponding expense. The cash outflow to reduce accounts payable caused cash to decrease by $5,000, but net income was not affected. So we need to subtract it. eGames interest payable increased $1,000 during the year. Interest payable is a current liability. An increase in interest payable indicates the company recorded interest expense of $1,000 for which it did not pay. In other words, the $1,000 increase in interest payable reduces net income because of the interest expense, but has no effect on cash. To adjust for cash being greater by $1,000, we need to add the increase back. Income tax payable decreased $2,000 during the year. Income tax payable is a current liability. Current liability decrease, we need to subtract it. Indicates that the company paid $2,000 cash to reduce a liability, but reported no corresponding expense during the period. So the cash outflow to reduce income tax payable caused cash to decrease by $2,000, but net income remained unaffected. So we need to subtract the decrease. Now that we have looked at the non-cash items, the non-operating items, and the change in current assets and current liabilities, we add them all together to get net cash flows from operations of $50,000.